Hello, this video will cover how to complete the quick study assigned problems for chapter 10. So I've already set up sales spreadsheet, and we'll start with the first one, which is in chapter 10 and item 6. So go to the table of contents, drop down menu, caret, go towards the end of the book or under the chapter, and we're looking for where's my numbers? Chapter 10, Allegiant issue 6% twin 20-year bonds with a par value of $2 million and semi-annual interest payments. In each separate situation, determine whether the bond is issued at par value, at a discount, or a premium. We're going to compare it to market. And for item 2, since interest contractual rate is the same as market, this will be issued par, and that's for number 2. And for number 1, the market is less than the contractual rate. So the going rate in the market is paying less than what we're offering. We're offering more. So in that scenario, think of it this way: since we're offering more, we can issue the bond at a premium. For number 3, the rate is actually higher in the market, so we're offering less. So our bonds would have to be discounted to give the same as what they're offering out there in the market. Okay. Again, because we're doing journal entries, I would use your template. So I'm going to pause the video right now so I can get my template. So now I have my format, and of course I want my indent spacing proper, so I'll go ahead and fix that. Click between the letters, and we're good to go. Alright, so the first one says Enviro company issues 8% 10-year bonds, par value $250,000. On the issue date, the annual market rate for those bonds is 10%, so it is more than the contractual rate, so this would be a discount situation, which implies a selling price of 87.5. There is an imaginary or invisible percentage sign afterwards, so this is how the standard quoting price. This is 87.5% of the par value. Prepare the journal entry for the issuance of the bonds on January 1. So my date would be January 1 of whatever year I'm issuing them. And then the next thing is I'm going to, because I'm the bond issuer, I'm actually the one borrowing the money. So I'm going to debit cash or whatever the proceeds are. And then what I'm going to do is I'm going to actually skip a row because just so that you can put the discount and the premium here. I do know it's a discount, but just for sake of showing you efficiency and how to easily journalize it, you're going to credit bonds payable. Bonds payable will always be credited for the amount of the par value, because that is the amount that will be paid back at the end. So no matter what, it has to equal par, and for this example, $250,000 is the par amount. And I need to make sure I put a comma, not a period. So 250,000, comma 3. And then for the cash proceeds, it's going to be the difference. So that'll be what, 2. So that would be 12.5 portion, which would be the discount. So the discount is a contra liability account. So I'm going to call this discount on bonds. And how do we get the amount? First thing I'm going to calculate the cash proceeds, which is going to equal the par amount multiplied by the 0.875. That's the 87.5%. I'm going to go ahead and enter. And then the difference between the 250,000, subtract the cash proceeds, that difference is going to be the discount portion. Or you can simply take the 12.5%, and you still come up with 31,250. And that's it for this quick study. The next one says Garcia Company issues 10%, 15-year bonds, par value 240, and then this one you'll see that the market rate is 8%, which happens to be less than the contractual rate. And so this one is issued at a premium. This number is greater than 100, so that'll be 117.5% of the par value. Now what I'm going to do is, since this is for number 8, I'm going to go ahead and copy the format template for from 7 to 8, so I can save myself some work. And then I'm going to just go in here and I'm going to change the 7 to 8, and you can do that with the F2 key. And then once I do that, I'm going to go ahead and correct that, and then I'm going to wipe out the discount. And I'm going to wipe that discount out because now I know this one is going to be a premium, and premiums are going to have a credit balance. They're not a contra liability. It's a liability account. So premium on bonds payable, or just bonds, however the chart of account has, but go ahead and use whatever is on Connect. And then what I'll do here is, this is par is now 240, so I got to change that to 240. 1, 2, 3. And then what I'll do here for the proceeds is going to equal the 117%. So that will be 1.17, and then a 5 to represent the 117.5%. Oh, I need to multiply, right? So I'm going to have to multiply that by, so the star key, and by the par value amount of 240. And then that amount is, of course, more. So you'll notice that that goes in line with that credit. So I'm going to take the difference between the proceeds and the par value to come up with the excess of the $42,000. And I have dollar signs in here. I don't want dollar signs. Doesn't really matter. It's just aesthetics, but I liked it to look consistent. And that's it. All right, so that's what we have for quick study 10-8. And then we have to do 10-9. And let's see, are there any journal entries required? Nope. So we're going to just go ahead and go to 9, and we'll call this quick study 10-9. Enviro Company issues 8% 10-year bonds with a par value of 250. On the issue date, the annual market rate is about 10%. So 10% is more, market is more than the stated. That means that we're issuing bonds at a discount. And they have a 117.25%. And they're using the straight line method for allocating interest expense. The first question is, what are the issuer's cash proceeds from the sale? So that number 1 will be pretty simple. All we'll need to do is, I'm going to go ahead and use the calculator in here, and that'll be the 1 equals 1 point. It's point, not comma. 1, 7, and then a quarter would be 25. So we'll put in 1.1725, and we'll multiply that by the par value. For this example, the par value is $250,000. And we'll go ahead and press enter. And to make this clearer, I would just go ahead and convert that to dollar amounts. And then I take out the extra cents. And 293, 125. And this is not a discount. Why is it this 117.14? Let's see, 8% issues, which applies. Okay. I think there's a problem with this one. Maybe I shouldn't assign this one. But a discount, it should be less than 100%, but it looks like the author said 117. Okay, yeah. It should be, that's a premium, not a discount. And that doesn't go in line with that. But anyway, we're going to go with what the numbers are here, because I don't know what the discount amount should be based on these interest rates. Item 2, you'll notice that when it's a premium, it's more, and this is why there was a red flag for me, because this is more than the 250. All right, so number 2 is, let's see, I'll have to let them know, send a message to the author, but we'll see. What total amount of bond interest will be recognized over the life of the bonds? Let's see. You're going to take the P times R times T formula. Principal times rate times time. P also stands for par. So this will be equal to 250,000. Try this again. Equal to 250,000. And star for multiplication times. Okay. Now the interest rate that you use is the stated rate, which is the 8%, 0.08. Okay, and then you will multiply that by the time. Now, because this one is semi-annual, that's 6 months, half a year, so that'll be 1 divided by 2, or 6 over 12. Either one, it's still 50%, so 6 over 12 is 6 months out of the 12 months. And the interest rate for every 6 months will be 10,000. So let me go ahead and make sure and this will be every 6 months. And so because this one is 10 years, that will be 20 periods of payments. So twice a year for 10 years is 20. And if you multiply this 20 by the 10,000 interest for every 6 months, you're talking about interest costs of 200,000 over the 10 years. All right. Now, based on what it says, again, this quoted price 117.25. I think somebody made a mistake when they were doing the textbook, but anyway, so that'll be the 200,000 in interest, and then because they get a premium of 117.14. Let's see, 117.4. So that 293 number. Make sure I got it right. Yeah. And I'm going to go ahead and put in there the difference. So if you go and you take equal sign and you take this 293,125 and you subtract the 250, we're getting an additional premium up front, right? And so we're getting an additional 43,125. So that's the premium. And then that premium will offset that expense of interest. So premium. And again, this is interest expense, not interest revenue. We are the bond issuer, so we are the ones that are actually borrowing the money. So we want to make sure that you treat that accordingly. And premium, offset it. The net cost would be the difference between this amount and 43125. So this would be, what are the total amount of bond interest being recognized over the life of these bonds? And this would be total interest over life of bonds. Okay, and then question 3 says, what is the amount of bond interest expense recorded on the first interest payment? And for this one, yeah, we already know that the payment is going to be 10,000. But because we're using straight line, we're going to take the 43,000 total premium, and you're going to divide that by 20, and that would be 2,150 amortized premium. So with the first payment, we're talking about 10,000 minus the 2,550, and that'll be this is the interest payment, and then the 7,844 is the interest expense. It looks like I labeled something properly up here. Let me fix it when I get a chance. This is 200,000 interest payment. Okay. And I'm really curious because this is not a discount, obviously. 117. I want to see what the answer key is. I'm gonna pause the video and I gotta pull it up. Yes, they did do a typo. This 117 1.25. It actually should be 87.5. So they made a mistake here. You'll notice on the answer key. I'm not sure. I'd be curious to see what AI would say the answer is for this problem. If I did a print screen or an image capture. But anyway, I did it based on the numbers provided, but you'll see right here, this is the actual solution if the typo, if it wasn't correct. So I'm going to go ahead and report this to the publisher because, you know, nothing's perfect. And we got 87.5. So if you did the 87.5, you'll see that's a true discount. You'll notice that the number, see it right here, because it's less than 100, it's going to be less than the 250. And then because you're receiving less than what you have to pay back, you're receiving actually what, 31,250 less. It's going to cost you a little bit more. So not just the interest payment, but because you got initially less than what you're going to have to pay back. And then it shows you here how to do the straight line method. You're basically taking the full 231,250 and divide it by 20. Another way you can do that is you already know that the payment for one period is 10,000, and because the discount is 31,250, if you divide that by 20, that would give you the $1,563 that's added to the 10,000, and you still should get the adjusted answer of 11,563. Okay, and again, I showed you the other option based on what the number was given, which was actually a typo. Okay, so let's go ahead and go to the next one, 16. And 16 is quick study, 10-16. Accounting for monthly installment note on January 1, $50,000 cash is borrowed from a bank in return for a 6% installment note with 24-month payments of $2,216 each. Prepare the journal entry to record the issuance of the note and the first interest payment. So I'm going to go to one of the pages that has, or sheet tabs that has a journal entry format, so I don't have to reinvent the wheel. And I'm going to go ahead and copy that in that first box, 8-1, Control V. And then I'm going to go ahead and change the 8 to 16. And I don't have to start over from scratch. Delete that information. And so the first one says record the issuance of the note. So January 1, that's the dates, happens to be the same. We're going to issue the note, so we're going to get the money, the cash money. And that amount we're borrowing is what, 50 grand. So we're going to debit 50,000, and then we are going to have a credit for the same amount. Now the credit amount on January 1 will be the full principal, which is the loan amount that's borrowed. So that would be, I will go ahead and just call this notes payable. It could be a mortgage payable. It's some form of instrument where it's a payable. So let's see, notes. Okay, and that's when we issue it. And I don't think there was an issue for an asset. Yeah, so we're good to go. The next one will be the first payment. It says these are monthly notes, so the note will be paid in a month. So let's say February 1st would be the first payment. And on this date, we're going to pay down the notes payable, but we're also going to recognize some interest that has accrued. The notes payable. Also debit interest expense for the installment note. It might be interest installment note, but interest expense. I'm going to just say interest expense. Make sure you pick the right account when you're doing this on Connect. And then those two amounts added together will be our payment. So that'll be a reduction in cash. So that's a credit to cash. And the payment they've told us is $22.16. So $22.16 is the equal payment. So every month we're paying this $22.16 to pay off this debt. And let's see, I want the same format. So I'll use the painter format brush. And then for the, oh, it's in the wrong row. Make sure you're properly crediting the cash account is where it should be. And then the interest, this is how you figure out the interest expense. What you'll do is you'll take the PRT formula, principal times rate times time. So the $50,000 is the unpaid balance for the very first payment. Installment is you're paying it as you go, kind of like a car payment or a house note, a student loan monthly payment, instead of the other notes where we waited to the end of the period to record the principal and the interest. Now you're doing it in installments throughout the life of the borrowing. And so I'm going to multiply this by the annual interest rate. Now the annual interest rate for this one was 6%, and you can assume that that is the annual unless otherwise stated. And so we'll take the 0.06, and then we're going to also multiply this by 1 month. It's not the full 24 months. We're just looking at time that has passed. So that'll be 1/12 since you have an annual interest rate. And this is the formula you will be using to calculate the interest. Once you figure out the interest, that's $250, then the pay down of the notes payable will be the difference between the payment and then subtract the interest accrued for that 30-day period, and together these two debits will equal the credit. And so that would be your answer to item 2 for 16. The last one that you were requested to do is 18, which is again a ratio, and as always you go to that page, and so I'm going to go ahead and click on 18, and I'm going to go to that link to the textbook. It's going to take me to the topic of my debt to equity. I'm going to do a screenshot capture, and I'll get a copy of exhibit 10.14. And then I'm going to paste it somewhere here on my spreadsheet, and this will be my quick study 10-18. And then I'll go back to the quick study problem, so I'll know exactly what I'll need to do. And it says compute the debt to equity ratio for each of the following companies. So we have Atlanta and we have Spokane. And we have our liabilities and equity. Keep in mind that debts is just another name for liabilities. So we'll go ahead and just divide our debt by our equity. And so for the first one, it'll be the 429. And if you're punching the calculator, you won't need to put in the zeros because 1,000 divided by 1,000 is still 1. So 429. And then I'll do 572. And then just to show you, if I did 429 divided by the 572, let's enter. And we get 0.75. And I'm going to show you if you copy that same exact formula, the two other numbers, you'll notice that you get the exact same number. So this is for the Atlanta company. So I'm going to do ATL. And then what I want you to do is you can do the same process for Spokane. The same process. You should be able to do it. Follow along in the video and you can compare the two. And then it asks you which company appears to have a riskier financing structure. So If you are more, you have your assets tied up in more liabilities, then that's considered riskier. So after you do this comparison, you're going to see who has the highest debt percentage to the overall equity. So whichever one has higher debt to equity would be the one that's kind of playing it by ear, more riskier. Okay, so that's all I'm going to give you. And remember, today is a great day to learn.